In recent times, the world of finance and investment has been rocked by a dire warning from renowned investor Jeremy Grantham. Everyone will be wiped out in 30 days. Such a statement carries a heavy weight of concern and uncertainty, leaving investors and the general public deeply intrigued and even fearful. In this exploration, we'll dissect Jeremy Grantham's ominous prediction, shedding light on its origins, context, and potential implications. We'll also assess whether current events align with this alarming forecast. Who is Jeremy Grantham? Jeremy Grantham is a prominent figure in the world of finance and investment. He hails from Britain but has a substantial presence in the United States. As one of the co-founders of Grantham, Mayo and Van Otterloo GMO, a respected Boston-based asset management firm, he has garnered recognition for his keen insights and ability to anticipate market trends. Grantham's track record includes prescient warnings about market bubbles and timely calls on major market downturns, making his pronouncements noteworthy in the financial world. The 30-day scenario. What does it mean? Grantham's 30-day warning is a cryptic message that implies a catastrophic event looming on the horizon. The phrase, "everyone will be wiped out in 30 days, is evocative of widespread financial and societal collapse, potentially affecting individuals, businesses, and governments alike. To appreciate the gravity of this statement, it is crucial to delve into the factors that could underpin such a grim scenario. Market instability and economic crises. Grantham's history of predicting market downturns suggests that he may be referring to a severe and sudden collapse of financial markets. This could involve a sharp decline in stock prices, a banking crisis, or a recession of unprecedented magnitude. Environmental and geopolitical factors. Grantham has also been vocal about the potential impact of environmental issues, such as climate change and resource scarcity, as well as geopolitical tensions. These factors could contribute to a broader crisis that affects the global economy, especially if they lead to disruptions in supply chains, energy shortages, or conflicts that disrupt trade. Pandemic and health crisis. In the context of recent events like the COVID-19 pandemic, concerns about public health and the capacity of healthcare systems to respond to a crisis may be a part of Grantham's warning. A new and highly contagious virus or another global health crisis could indeed have far-reaching consequences. Financial market speculation. Grantham has expressed concerns about market speculation and the detachment of stock prices from fundamental economic realities. If speculative bubbles were to burst suddenly, it could lead to a rapid and devastating market correction. Assessing current events. Do they align with Grantham's warning? To evaluate the credibility of Grantham's ominous prediction, it is essential to examine current events and market conditions. We'll need to analyze whether these circumstances align with Grantham's 30-day scenario, or if there are factors that may mitigate the severity of the warning. In conclusion, Jeremy Grantham's warning of "everyone will be wiped out in 30 days" is a stark reminder of the fragility of financial markets and the global economy. While Grantham's track record of predicting market downturns is noteworthy, it is crucial to approach such warnings with a balanced perspective and a critical eye. The analysis of current events and market conditions will help shed light on the validity and potential implications of this alarming forecast. Historical context. Lessons from financial crashes and market crises. Before dissecting Jeremy Grantham's warning of potential catastrophe, it's essential to consider the historical context of financial crises. Examining events like the Great Depression, the dot-com bubble, and the 2008 financial crisis provides valuable insights. The Great Depression underscores the dangers of speculative bubbles and the need for regulatory reforms. The dot-com bubble highlights the perils of irrational exuberance and the importance of due diligence. The 2008 financial crisis emphasizes systemic risk and regulatory reforms. These historical lessons are relevant today as we observe elements of market exuberance, speculative behavior, and concerns about asset bubbles. It's crucial to draw on these lessons for risk management, regulatory vigilance, due diligence, and maintaining a long-term investment perspective. By learning from past mistakes and successes, we can make informed investment decisions and be better prepared for the challenges and opportunities that may arise, whether or not they align with Jeremy Grantham's alarming warning of potential catastrophe. Incorporating the wisdom gained from historical financial crises into our current financial decision-making process is paramount. These lessons underscore the importance of vigilance, diversification, and a long-term perspective in our investment strategies. Whether or not Grantham's warning materializes, the knowledge gleaned from the past equips us with valuable tools to navigate the uncertainties of today's markets and build a more resilient financial future. Current economic landscape. To assess the validity of Grantham's warning, we must examine the current economic landscape. This section will delve into key economic indicators, such as inflation, unemployment rates, and GDP growth. We'll also discuss the Federal Reserve's monetary policy and its impact on the markets. Assessing Grantham's warning, examining the current economic landscape. To determine the credibility of Jeremy Grantham's alarming prediction, it's crucial to scrutinize the present economic landscape. This involves a comprehensive analysis of key economic indicators that shed light on the overall health of the economy. Key factors under examination include inflation, unemployment rates, and GDP growth. Inflation serves as a critical barometer of economic stability. Persistent high inflation can erode purchasing power and disrupt financial markets. Conversely, low or deflationary pressures may indicate an economic slowdown. Assessing current inflation trends helps in evaluating the potential risks to the economy. Unemployment rates provide insights into the labor market's health. Low unemployment rates suggest a robust job market and consumer confidence, while high rates can signal economic distress. A thorough examination of employment data can help gauge the economy's resilience. GDP growth is a fundamental metric reflecting economic expansion or contraction. Positive GDP growth indicates a healthy economy, while negative growth can indicate a recession. Analyzing the current trajectory of GDP growth helps in understanding the overall economic momentum. Moreover, it's imperative to consider the Federal Reserve's monetary policy and its influence on financial markets. The central bank's decisions regarding interest rates, quantitative easing, and other monetary tools have significant repercussions on investor sentiment and market stability. An assessment of the Federal Reserve's actions and statements can provide valuable insights into the potential direction of the economy. By closely monitoring these economic indicators and the Federal Reserve's policy stance, we can better contextualize Jeremy Grantham's warning and assess whether current economic conditions align with the ominous scenario he has presented. This analysis enables us to make informed decisions about our investments and financial preparedness, regardless of the outcome of Grantham's prediction. Environmental and geopolitical factors. Jeremy Grantham's focus on environmental sustainability and resource scarcity has been a recurring theme in his assessments of global economic trends. In considering the potential validity of his warning regarding a 30-day scenario, it's essential to examine the significant roles that climate change, resource depletion, and geopolitical tensions play in shaping the global economic landscape. Climate change is an increasingly urgent concern with far-reaching economic implications. The growing frequency and severity of extreme weather events, as well as shifting climate patterns, can disrupt agricultural production, cause infrastructure damage, and lead to increased insurance costs. Mitigating climate change and adapting to its effects are significant challenges that can impact economic stability. Resource depletion, particularly in the context of finite resources like fossil fuels and minerals, poses risks to global economies. As demand for essential resources continues to rise, scarcity can lead to price volatility, supply chain disruptions, and geopolitical conflicts over access to these valuable commodities. Resource scarcity can also impact industries reliant on these materials. Geopolitical tensions are another critical factor affecting the global economic outlook. Disputes over resources, territorial claims, trade disputes, and political instability can disrupt international trade, disrupt supply chains, and heighten uncertainty for businesses and investors. While these factors individually may not necessarily predict a 30-day scenario, their interplay and sudden exacerbation could contribute to a rapid and severe economic downturn. Grantham's emphasis on these issues suggests that he may be considering their collective impact on the global economy when issuing his warning. Therefore, it's essential to monitor developments in climate change, resource availability, and geopolitical relations as potential catalysts for economic volatility, even if they don't lead to an immediate, catastrophic scenario within 30 days. Market analysis. In this section, we conduct a comprehensive analysis of contemporary market conditions. This involves scrutinizing stock market valuations, corporate earnings, and investor sentiment. We also evaluate the performance of diverse asset classes. The primary objective is to gauge the potential for a market crash within the next 30 days. By considering these critical factors, we aim to provide a well-rounded perspective on the current state of financial markets and the likelihood of any imminent, severe downturn. Contingency planning? Contingency planning in the face of Grantham's warning, protecting financial interests in a market downturn. Jeremy Grantham's dire 30-day warning has sparked concerns about the potential for a severe market downturn. In response to such a grave scenario, individuals and institutions must consider contingency planning to safeguard their financial interests. Here, we explore essential steps and strategies for risk management and asset allocation in preparation for challenging economic times. Diversification is key. Diversify your investment portfolio across various asset classes, such as stocks, bonds, real estate, and commodities. This can help spread risk and reduce exposure to any single market's fluctuations. Build a robust emergency fund. Ensure you have an adequate emergency fund in place, typically covering 3 to 6 months of living expenses. This fund serves as a financial safety net in case of job loss or unexpected expenses during a downturn. Review your risk tolerance. Assess your risk tolerance and adjust your investment strategy accordingly. If Grantham's warning is particularly concerning, consider shifting toward a more conservative asset allocation, with a greater emphasis on lower-risk investments. Maintain a long-term perspective. Avoid panic selling in response to market volatility. Markets often recover over time, and knee-jerk reactions can lead to substantial losses. A long-term perspective is essential. Reevaluate your investment goals. In light of the warning, revisit your investment goals and timelines. Adjust your strategy if necessary to align with your financial objectives and risk tolerance. Risk management through asset allocation. Employ a well-thought-out asset allocation strategy that balances risk and return. Consider the proportion of assets in your portfolio allocated to equities, fixed income, and alternative investments. Seek professional guidance. Consult a financial advisor or investment professional to help tailor your investment strategy to your specific needs and risk tolerance. They can provide valuable insights and expertise during uncertain times. Liquidity planning. Ensure you have access to sufficient liquidity in your investments to cover short-term financial needs. Avoid locking all your funds in illiquid assets. Stay informed and adaptive. Continuously monitor financial news and economic indicators to stay informed about market developments. Be prepared to adapt your strategy as the situation evolves. Explore hedging strategies. Consider hedging strategies such as options or inverse exchange-traded funds, ETFs, which can help protect your portfolio during market downturns. Debt management. Manage your debt responsibly. High-interest debt can exacerbate financial challenges during economic crises. Prioritize paying down high-interest loans to reduce financial stress. Preserve cash reserves. Hold some cash reserves or invest in short-term, low-risk assets to ensure you have funds readily available for immediate needs or investment opportunities. Regularly reassess your plan. Periodically review and adjust your contingency plan as your financial circumstances and the economic landscape change. Flexibility and adaptability are vital. In conclusion, the severity of Jeremy Grantham's warning warrants careful consideration and proactive measures for financial protection. A well-thought-out contingency plan that includes diversification, liquidity management, and risk mitigation strategies can help individuals and institutions navigate the uncertainty of a severe market downturn. Ultimately, while it's prudent to prepare for the worst, maintaining a balanced and informed approach to investing remains essential in uncertain times. Conclusion. In summary, Jeremy Grantham's alarming 30-day warning serves as a stark wake-up call, highlighting the vulnerability of both financial markets and the global economy. While Grantham's track record of accurate predictions commands respect, it is imperative to exercise caution and maintain a healthy dose of skepticism when evaluating such ominous forecasts.
Throughout this exploration, we've undertaken a comprehensive analysis that spanned historical context, the present economic landscape, environmental and geopolitical considerations, and current market conditions.
This multifaceted examination has provided a well-rounded perspective on the situation. In navigating these uncertain times, it becomes clear that preparation and informed decision-making are paramount. This includes diversifying investments, building emergency funds, and regularly reassessing financial strategies to align with risk tolerance and objectives. Furthermore, staying abreast of relevant economic and geopolitical developments remains crucial for making prudent financial decisions. While the gravity of Grantham's warning demands attention, it also underscores the importance of resilience and adaptability in the face of evolving economic landscapes. As history has shown, markets can be unpredictable, but with careful planning and a measured response, individuals and institutions can better weather the challenges that may arise, whether they align with Grantham's warning or not.